Hello and welcome. You're watching ET Markets. I'm Tanya Aneja. Well, markets continue to remain volatile this week due to a host of factors such as US Fed rate hike decision, monthly derivatives expiry, Q1 earnings, and much more. So, where are the markets headed in the near term? Which are the themes you should focus on at this point in time? To discuss this and much more, I'm going to be joined by a very special guest today. We have with us Mr. Sudip Bandyopadhyay, who is the Group Chairman at Inditrade Capital. Thank you so much, Mr. Bandyopadhyay, for joining us on ET Markets.
Thank you, Tanya. Thanks for inviting me.
So everyone is now focusing on the big FOMC meeting. I mean, all eyes are on the quantum of the rate hike the US Central Bank may go with this time. So a 75 basis point rate hike is what the market was looking at a few days ago. But given the inflationary pressure in the world's largest economy, 100 basis points rate hike cannot be ruled out. So what are your expectations and how do we react to that here in India? I mean, what are the implications of the rate hike for us here?
Well, Tanya, I think you summed it up pretty correctly. Initially, people were talking about 75. In between, there was a talk of 100 basis point. But based on multiple statements coming out from various Fed members before the silent period started, the market again, I think, is having kind of consensus. There's about 75 basis point hike by Fed, which will get announced, towards the end of the day, US today. So we will get to react tomorrow on that. And market is already factored in that 75 basis point hike. So in case the Fed goes ahead and sticks to the script and hikes by 75 basis point, I think there would not be much change in the market scenario. However, if there is a outside chance of 100 basis point hike, yes, there will be a bit of a reaction, and I think market will digest it and move ahead. But the reaction will be there in the very, very short term. Maybe we'll see for 1 day or 2 days, but that's about it. You would have seen that when there is a US Fed interest rate hike or a big hike, initially the market reacts negatively. And then I think market starts looking at it positively that, the pain is out of the way. Whatever had to happen has already happened. Now onwards, the pace of hike will come down. So, all kind of positive future kind of predictions start emerging, and markets start correcting and start improving once again. So I would say similar thing will play out. If 75 basis point, nothing changes. If 100 basis point US Fed hikes, then yes, we'll have some negative reaction in the initial few days maybe. And then market will again start stabilizing and focusing on other factors like corporate results, both in US and other parts of the world. The progress of the geopolitical challenges, particularly Russia-Ukraine war, and related commodity pricing pressures, etc. By and large, I think the entire capital market direction globally and also India consequently will depend in the medium term on the way the geopolitical issues evolve. That's our strong view. Hiking of interest rate by central banks is to a great extent factored in.
Okay. And do you think that the global markets are still worried about a recession?
Yes, to a great extent they are. There is a challenge, big challenge in Europe. I think Europe is one bloc which is the worst performing economic bloc at this stage. There are concerns in US, but our reading says that I think US is quite from recession. The demand for the jobs data which is coming out periodically from US doesn't point to a recession or any recessionary trend yet. However, the inflation continues to be very high, and which is compelling the Fed to continuously increase interest rates. And beyond a point, if the interest rates go up, there will be a recessionary trend. That's undoubtedly true. But I think at this stage, to talk about a US recession is a bit premature. Other parts of the world, particularly Asia, if you talk about Asia ex-China, I think we are not in a recessionary zone. Yes, there are inflation challenges. Yes, there are currency-related challenges, but not anywhere remotely near inflation, recession.
Okay, absolutely. And also, Mr. Bandyopadhyay, what do you make out of corporate earnings announced so far? I mean, what are your thoughts on earnings downgrade and expectations for FY23?
I think it's been a mixed bag as far as Q1 numbers are concerned. What we have seen till now,
Okay.
BFSI very clearly is a winner. I think we were expecting good results from BFSI, and pretty much the same thing has happened. Look at results of a bank like ICICI or even Axis Bank, IndusInd Bank. Fantastic numbers they have come up with.
Yeah.
We have seen these kind of numbers from large banks after a very, very long time, and it's quite encouraging. Undoubtedly, the credit demand is back, and that again takes me to your earlier question. We are some distance away from recession because credit demand is going up in India. Also, the asset quality is improving remarkably. Now, most of these banks were plagued with asset quality challenges, and that's, I think, receding significantly. And these two are harbingers of good times going ahead. So we are extremely positive, and that's pretty much getting reflected in Q1 results.
Okay.
The other sector which has positively surprised the market has been the automobile sector. There were not too much of expectation, but the results have been much better than expectations. There are pockets of the automobile pack which definitely needs a relook, particularly the tractor segment, the commercial vehicle segment. The other segment have shown good results, and the corporates have posted good results, whether it's a Bajaj Auto in two-wheelers or let's say the other four-wheeler companies. But I think there are too many headwinds. So we have been advising caution as far as other categories of four-wheelers are concerned at this stage, and even two-wheelers. The other sector which I definitely should talk about is the FMCG, the consumption theme overall. I think, again, this is one sector which has withstood the challenges of cost inflation very, very well. They have taken it in their stride. They have gone ahead and taken the price hikes wherever demand is to an extent inelastic. They have also reduced the pack size to kind of maintain margins. They have done effective cost control so that, yes, somewhere margins have suffered a bit, but the volumes have gone up, and overall the results have been pretty good. If you consider the FMCG leader HUL, the results have been very, very good under the circumstances, and the market to an extent has rewarded it also. The other pocket I will also highlight is that general consumption. Look at paints. Now the market leader has posted fantastic results, Asian Paints. And what we are seeing as a trend in the midst of all this adversity, cost pressures, to an extent the slowdown in rural demand, we've been seeing the leaders gaining market share. Whether it's an HUL or an Asian Paints, the leaders are becoming stronger and stronger. Maybe the challenge is with the weaker players in the industry, and they are grappling with multiple issues. But overall, as an industry, as a stock market participant, I think it's a good time for these sectors because you pick up the leaders and you win.
So, okay, so these are the themes that you're focusing on right now, or are there any other sectors that you are betting on at this point in time?
By and large, I think these are the sectors. I talked about FMCG, I talked about segments in automobiles, and I talked about BFSI. These are the sectors which are our go-to sectors. Apart from this, there are pockets like some of the cement companies, some of the construction and infrastructure related companies, where we have been positive. The leader in the infrastructure construction pack, which is L&T, we are positive. I think there's a significant tailwind behind it with public spending going up and also private capex coming back. L&T should do very well going forward. That's what our belief is. And at current valuations, still it looks attractive if somebody is buying it for a 1 year plus hold. In the cement pack, again, we believe the overall consumption theme will play out, coupled with the infrastructure push by government and private sector. Again, there the industry leader, which is Ultratech, we are very positive on that. And instead of going to mid-tier or the third-tier companies, it's better to stick to the industry leaders in a challenging atmosphere.
Absolutely. And what about the mid-cap and small-cap space? Have they come down to attractive valuations yet?
Well, I think this is a very large universe, and we rather classifying is at mid cap, small cap. We look at individual companies and sectors and take our picks.
Okay.
I can talk about the specialty chemicals. I think the fluorocarbon sector is globally witnessing a huge boom. Chinese manufacturers, large manufacturers in China, if you read their commentary, they are flourishing with orders and order backlogs. There is a very, very strong demand in fluorocarbons, and that's getting reflected when you look at Indian specialty chemicals in the fluorocarbon chemical sector, like Naveen Fluorine or a SRF. And now these are mid-cap companies, and one can look at buying this for long-term or medium-term. Similarly, there are tire companies. Let's say off-road tire company Balakrishna Industries looks pretty good at current stage. Auto ancillary is another sector we have been extremely bullish. Our thesis is that the automobile, particularly four-wheeler pack, will get destabilized to a great extent by the emergence of EV. Now, all the players are talking about getting into that segment, are trying to get their act together, but it's extremely uncertain who will be the winner, who will succeed, who will not. So to take a punt on Maruti or a Tata Motors at this stage, we are a little hesitant. Whereas look at the automobile component manufacturers. Now for them, EV is a great opportunity. Per car, EV car, the auto component percentage goes up. And some of our Indian auto component manufacturers are globally diversified with OEM linkages to large global automobile manufacturers who have their EV strategy very well stitched and in place. And remember, for them to tweak their manufacturing from an IC engine to EV is very, very easy. It's not like an automobile company which has to completely change everything when they move from IC to EV. So for automobile component companies, particularly, let's say Motherson Sumi, Bharat Forge, Minda Industries, I think you can take your pick. One of these frontline auto ancillary companies can be picked up for long term.
Okay, all right. And now let's come to your market outlook. I mean, do you think all the negatives have been discounted by the market, or do you think there is still a possibility of another deep correction in rest of the calendar year?
Well, we believe that the biggest factor, which I was alluding to earlier, is that the Ukraine-Russia war. Yeah. I think if this war stops at some point of time, I mean, it has to stop, but whenever it stops, I think you will see an immediate change in the texture and tenure of the market. Everything will become positive overnight. The commodity prices will start coming down. The risk-on mood will be back. Because remember, the money is there. The central banks world over have pumped a lot of money into the markets, into the economies. And that money is there. That money has not been taken out. What is being taken out by quantitative reverse of quantitative easing by US Fed and other regulators is only a small fraction. So money is there. It is just that the risk of mood because of multiple factors. The moment the basic reason for the risk of mood, which is the war and related challenges of the commodity prices, disappears, I think we'll see a sea change in the market texture. Okay. Remember inflation, which is what being talked about, and all these rate hikes and everything is related to inflation. Now, the simple source of inflation is supply side push. It is not the demand push this time. It is the supply side. The supply side is getting plagued by this war. So my view is that there is a significant upswing waiting to come. Just that geopolitical thing needs to be settled. Beyond that, I don't think there is much of a challenge as far as Indian markets are concerned. We are still the fastest growing economy in the world. God willing, will continue to grow at a decent pace, which is somewhere between, under the current circumstances, between 6 and 7%. If things improve, it will be significantly higher. So there is nothing much price correction which we have seen. I mean, from the peak level, I think 17-18% correction we did see. Some amount of recovery has also come now. But still, I think, this passage of time and corporate earnings improving, on a multiple basis, things have started looking much better compared to what it was, let's say, 6-8 months back.
Okay, that's the word coming in. Also, lastly, the one thing that changed last week was FIIs turning positive on the Indian markets. They have been net sellers, but they were showing early signs of taking a U-turn. So do you see the trend reversing, or these are still early days?
Well, I think it's a very small way, I wouldn't say reversal of trend. I would rather say emergence of a new trend. At some stage, FIIs are realizing that while their risk on mood is still not there. But if they have deployable surplus and they have to deploy outside of US, I think India is one market where a couple of things are happening. Valuations have become attractive compared to when they exited probably, or they started exiting. So the same stock which they exited at a certain PE multiple is available now at a much better multiple. So it makes sense for them to come back. That's point number one. Point number two, I think currency depreciation, it makes it a little more attractive at this stage for them because they can buy more shares for the same amount of dollars. So that's the second point. The third point also is very important, again got to do with geopolitics, is that I think there has been a lot of challenges in investing in China. Now, when they are moving out of China, taking money out from China, if there is an emerging market fund, they need to put in some other emerging market. And probably India is the best position there to attract capital. So I think all these factors have started playing and they will continue to play. So I would rather say this is a new trend or a new new era which will emerge, which will be like specialty chemical, like other manufacturing, where we saw China +1 or China minus and India plus. For the FII point of view, that strategy will start getting played out. That is going to be very important for the next level of capital market growth in India.
Okay, that's the advice that is coming in from Mr. Bandyopadhyay. On that wonderful note, thank you so much for taking the time out and being with us here on ET Markets today. Thank you so much.
Thank you.